Hey folks, I'm Chris Versace, Portfolio Manager of the Street Pro Portfolio, and thanks for joining me on this latest episode of the Stocks and Market Podcast, where we talk about everything ranging from what's driving the markets to particular stocks and everything in between. In this time around, we have a pretty special conversation, one that I think is going to resonate extremely well with Pro Portfolio members, because we'll be talking with Mark Klein, the Chairman and CEO of SuRo Capital. And this is a Pro Portfolio position, and it's a company that we're pretty bullish on given its prospects, both for its investment portfolio, but for the dividend opportunity that we see ahead. Mark, thank you so much for joining me.
Thanks for having me, Chris. Really appreciate it.
So, Mark, I know SuRo Capital. We know you know SuRo Capital. The Pro Portfolio folks do, but we do reach a wider audience than that. So, give us the elevator pitch, if you can, for SuRo, its investment portfolio, and what you guys do.
Thank you. So, SuRo's been around for 14 years. It's been publicly traded, and the premise was to provide access to some of the best private companies around. And 14 years ago, it was very hard to access any private companies, and companies were starting to stay private longer. So the idea of being able to get in early on growth-oriented companies was really challenged, and that's only exacerbated over time. So we've been around since 2011. We've owned names over the years like Facebook and Twitter and Palantir and Lyft and Spotify and Dropbox.
Well, hey, slow down. So when you rattle those off, these are the big names driving the market today.
Absolutely. And so our investors have been very fortunate that we're able to provide access very early to those names. And we've continued to do that straight through to 2025. In fact, during the period of 2020 to 2022, which was obviously a robust time in the market, we were fortunate enough to be able to distribute to our investors more capital than we actually had coming into that year. So almost $9 in dividends.
I was going to say, that's impressive. And I think it shows the power of the BDC or Business Development Corporation model that you guys have. But I think a lot of folks, are probably sitting there going, wow, I listened to these companies that you're invested in. We know some of the ones you're invested in now, CoreWeave, Plaid, you were just exiting a position in Service Titan and others. How do you identify these companies, Mark? How does the team kind of think about the world, if you will, to recognize these opportunities early enough to get in on them?
Yeah, I mean, it's investing, and it's not easy. And we use both bottoms up and a top down approach to investing our money. And we are typically in mid to later stage companies that are either institutionally backed or venture capital backed companies. In this last iteration, as we came out of 2022 and the beginning of ChatGPT, our first thought was, what companies are going to benefit from it and what are going to be disruptive by it? And that was the lens that we looked at companies through very much as we were moving almost through 2023 and into 2024. In 2024, after it was pretty established that AI was going to be something massive, we wanted to understand how directly to invest in AI, and not necessarily end product specific, but picks and shovels and sort of the baseline of an infrastructure. And that's how we ended up investing in CoreWeave, OpenAI, Vast. We had investment in Oklo, obviously the nuclear power and companies. So this is how we approached that, and thematically how we got there, and then tried to find the best of breed and the leaders in their space, and then be able to access it for our investors.
Well, I like what you're saying thematically, because as Pro Portfolio members know, we tend to look at the world that way with our various strategies, everything from AI, digital infrastructure, as you said, picks and shovels, but also the energy pain point, right? We have an investment in Eaton Corp, which is a play on the exploding demand for electricity. So that registers extremely well with me. But let's talk, Mark, about some more of the portfolio, because I think a lot of people are talking about CoreWeave, a lot of people talking about OpenAI, but those are two great investments in your portfolio. But just two investments in your portfolio.
And they're very large. CoreWeave is the largest investment at cost we've ever made in 14 years. The next largest investment before that was Twitter in 2014. So we were very committed to make that investment. OpenAI is the second largest investment we've made, And so we sort of pushed all the chips into the middle last year in that space. But sure, that is only a couple of names in our portfolio. As you alluded to, is Service Titan. In 2023, we made an investment in Service Titan. We loved the business. The way the capital structure was set up, we felt it would go public by the end of 2024, which it did. It was a very, very successful IPO. And like others, once we were able to sell our stock and lock up a release, we've sold it. And we did sell Service Titan with a very sizable gain for our investors. Some of the other names in our portfolio that continuing on the AI side is Vast Data. So most people don't know Vast Data. Vast Data is really how data is manipulated, both retrieval and storage for AI use cases. I believe in the next couple of months, it'll be a name that'll be in the forefront of everybody, but it is a name that people don't really recognize. Moving away from the AI front, we made an investment a little while back in Whoop. And Whoop is obviously a health wearable device. It just introduced its next version, the Whoop 5, which has a medical grade to it. It's fantastic. I'm wearing mine. I haven't taken it off since I got it.
So what I like about Whoop, is the subscription nature of the business model, and they're almost, if I remember correctly, they're giving the device away for free today, to capture that subscription revenue. Right.
They're absolutely inverted from Aura.
Yeah.
So, and that's who they're compared to most often. And Aura is you buy the ring and then you pay a de minimis subscription. With Whoop, there's no upfront, but you buy, you subscribe to it. So you have the valuation based on a subscription model as opposed to a hardware model. So we found that to be very interesting. I think you'll see that the users of Whoop are a little different than Aura. Both of them, they track sleep and some other things. But Whoop is for really the athlete's athlete. So you have Ronaldo wears it, Patrick Mahomes wear it. Most of the professional golfers wear them. It's a slightly different use case than Aura, and our valuation right now is substantially less than where Aura was recently valued in their last round. We're extremely excited about Whoop.
But, so you just said something that's pretty interesting, right? That you kind of discount your value in the portfolio, it sounds like, for some of these investments. That kind of argues that you guys are more conservative than you could be. Maybe there's a little upside, maybe, to some figures that are in those portfolios?
Well, our valuation process is amazingly rigorous. I won't bore you with it, but suffice it to say it takes weeks for us to value our portfolio every single quarter. And that valuation goes through our independent valuation committee, our audit committee, our valuation committee. So our value matters to our investors because it's how folks can determine whether they should enter into our portfolio or not.
Right. It helps sets the net asset value per share. How are you trading? Where's your stock price? These sort of things.
But we, as part of our valuation, we look holistically based on either rounds that have occurred, secondary trading, or public comparables. And there are instances where we discount the value for a multitude of reasons, especially if we have public companies that their stocks aren't registered, there's discounts applied to that, extreme volatility, discounts applied to that. So we do our best to be as accurate as we can with our valuations.
Yeah, but you're hitting, to be fair, you're kind of hitting a little bit of a moving target.
Sure, and when a market's moving as fast as it's going,
like it has been, our
valuations tend to lag.
Okay.
And a perfect example was, we had a net asset value at the end of Q1 of about $6.66. We just published a pre-release of our NAV of between $9 and $9.50. Right. And that just doesn't happen in a day. So, the markets had moved over those 3 months and significantly impacted our portfolio.
Well, I will say, as again, we own SuRo Capital shares in the portfolio. I would much rather hear that you're rigorous and conservative than aggressive and stretching.
Right, that's just not what we do.
Yeah, no, that's just, I think it bears repeating. So,
thank you.
So you got some other companies in the portfolio. You just made a new addition with Plaid.
Sure.
Why now with Plaid? What's the opportunity?
I will tell you, we've been trying to own Plaid since 2018. So that's a long time for anybody. Plaid is one of the best fintech companies out there. It was almost bought by Visa several years ago, and that deal ultimately didn't happen. And this was a period of time where Plaid was raising money. and in a secondary manner where there was access for investors like us to invest, and it was stated as their last round before they go public.
Okay.
We're extremely excited with Plaid, and it's when you look at the fintech landscape, which there's a multitude of companies, this is clearly one of the best in the space.
Now, you just said last round before they go public.
That's how they've framed it.
Okay, so where I'm going with this is one of the things that attracted me to the stock as an investor is the BDC, or business development company structure, because you have to pay out 90% of your profits to shareholders in the forms of dividends. Right. So when I think about Surro, a lot of folks tend to think about most stocks in terms of price return.
Sure.
This is not that.
We're a total return.
Total return, exactly, which for some folks, who may not be familiar, it's a combination of capital appreciation, dividend income, you lump them together, total return. And, you guys hadn't paid dividends for a while. The IPO market was not, friendly, let's say. And one of the catalysts that I saw is, eventually, as some of these deals go public, you will have to come back and start paying dividends.
Right.
And you recently announced that you sold out of your position of Service Titan. You sold, I think, 40% of CoreWeave, 40% of CoreWeave position, and you started to return. You announced the return of dividends. The first one's 25 cents a share, payable at the end of July.
Correct.
Okay.
So, as I said before, in the 2020 to 22 period, we paid out approximately $9 in dividends, which was about, I think our stock price started around 11 or 12. So it was a very huge. And we're really transparent about our dividends. We want our investors to understand our cadence and what it looks like, so there's not a lot of surprises. That's really a hallmark of ours, being very communicative. So as you said, as a business development company with capital gain income, we have to distribute virtually all of it. Right. So we've started, in a press release, there's limited things you can really communicate.
Of course.
So our first conversation was, what we did about a week ago is we declared a 25-cent dividend, and we said we anticipate more dividends to come throughout the year.
Correct.
And as we continue to monetize portions of our portfolio, which we would expect we would do, whether it's CoreWeave or some of the other names that we have the ability to exit, that have either have completed IPOs and off of their lockup period, we will monetize those. We will communicate our dividends, and we will distribute a fair amount between now and the end of the year.
Right, and just because of that 90% figure, you mentioned, like I said, a 25-cent dividend per share. Maybe you have another something like that, but it is possible that as you get closer to the end of the year, as you kind of true things up, you might have to have a special dividend. Not saying you will, but it's possible.
We do our best to sort of anticipate where our monetizations are, and then we want to communicate that. And our ability to break those dividends up as opposed to one super large dividend is our goal. We may not have that opportunity. It depends how our monetizations go. And if that's the case, we would declare a significantly larger dividend as you called it, a special dividend. But we are hopeful that we can have it a little bit more of a cadence. I think it's better for our investors.
Oh, it's smoother, yes.
And it's smoother. So that's the anticipation.
Okay. So 2 questions to follow up on that. One is, if the IPO market for some reason slows down again, is that monetization at risk, or are there other levers to monetization that you can pull, M&A in the portfolio or something else?
Sure. Well, first of all, we have our largest positions already IPO'd, and the lockup expires sometime next month. So that is clearly one that we can monetize over time. We have another one, Columbia Acquisition 2, which closes their merger today with Grab-A-Gun. Is actually going to ring the bell tomorrow at the New York Stock Exchange, and that we'll be free to trade that sometime by the end of the year. Okay. So those are monetizations that exist. We've been able to monetize in a couple of different ways in the past. We can sell back into the private markets. There is a private market for a lot of our names if we choose to do that. There is M&A activity that occurs. In the 20 to 22 period, there was a lot of SPAC activity, so several of our companies went public via SPAC. I think the world's quite different right now. So there's a lot of different ways that we can have monetizations, but I think where I thought CoreWeave was initially going to be the beginning of the IPO, and then it was a test of the IPO. The IPO market is clearly opening up.
Oh, no.
And so if the markets continue to stay firm, I believe the IPO market will remain open, and we have several names in our portfolio that will probably go public in the next 12 to 18 months.
Yeah, so I agree with you, but I just wanted to,
Sure. No,
for people who are listening to understand that that's not the only route for monetization.
No, there's multiple ways for us to monetize.
Right. And but I agree with you. And as J.P. Morgan, Citibank, and Wells Fargo reported, and I suspect we'll hear from others, the backlog of investment banking activity, IPOs, M&A, it should be a better second half of the year.
I think so. I think what folks thought was going to would have happened end of Q1 into Q2 is probably mostly pushed into next month or into Q3 and Q4.
Okay.
That's what
So my second follow-up is you're clearly now reaping the benefits or about to reap the benefits of investments that you made 2, 3, 4 years ago, right? And I know as a portfolio manager, you're always looking for fresh opportunities. Sometimes you have to make room for those opportunities.
Sure.
So what are some of the things kind of on your radar screen today for future investment?
Right. It's an interesting phenomenon. It's thank you for what you did yesterday, but what are you going to do for us tomorrow?
Yes.
And so we're on that that ongoing treadmill. And a lot of the investments, Ken, we really made last year that we're reaping the benefit. It's been pretty amazing for us. But as we look out, and this is a question is what's next?
Right.
And we continue to move up the chain in AI and go above that sort of base layer of infrastructure to, software that takes advantage of AI, manages AI, into the agentic side of it. There's a lot going on. Our deal flow is almost impossible to keep up with. There's an awful lot going on. I think the biggest challenge for us, because we're seeing a lot and have the ability to access a lot, is picking the right ones and the right price. Mm-hmm. So which have the right to win and which are priced in a manner that works. And I'll give you a statistic because we've started to look at this. There are a lot of companies that are raising money that are valued somewhere between, call it 1 and 5 billion. And how many companies do you think, I'll answer the question for you.
Yeah.
How many companies do you think, it's rhetorical, you think are worth privately more than $10 billion right now? 75.
Really?
So if you're buying a company at 5 billion, and there's only 75 of them that are 10 billion, which is a double, and that would be 30 some odd percent IRR over a couple of years. You have to be right because you're starting to get rarefied air. So we spend a lot of time identifying who really we believe have the right to win in somewhat crowded spaces, and can we access it at the right value. So clearly the AI side, there's a lot going on. Fintech, there is an awful lot going on too. It's become a pretty exciting space again. So we're spending a lot of time in both of those spaces, and I would say our deal flow is clearly at the highest level it's ever been, which is great. But there is froth out there, and you have to you could easily misstep and be right on the company and wrong on the valuation.
So how do you maintain that discipline?
I mean, we've been doing it for a long time. I mean, it's really hard sometimes, and look at any time in markets where there's been excesses. Those have been tough years for people to win unless they were really selective. We did a pretty good job. We sold out a good chunk of our portfolio in 2022 and sat mostly in cash, at least 50% in cash, till almost 2024. So we've tried to find our spots and then we deploy it. There is a lot of actionable ideas, so I expect we will redeploy a lot of our capital that we're monetizing and that's not being distributed to our investors. It happens to be, it's a fun time now, Chris.
Yeah, 100%. 100%.
We've been patient. We've zigged basically when we should have zigged. We've zagged basically when we should have zagged. And we are, as you said, reaping the benefits now. But I think we're earlier. We're not later in the game. We're sort of earlier. And the IPO market is catching up. The private capital raising is now catching up to what's going on. And we're right in the middle of it. It's really a fun time.
So 36 positions, 3 public companies. We've talked about some of the larger ones and the big opportunities there, but look, we all know portfolio theory. There's not everything works all the time.
Sure.
So, if you look through, I think your 10Q, you guys do a wonderful job kind of recapping all the portfolio's positions. there's a couple in there that
We
are
don't
not
always
great.
win.
Yeah, exactly.
Of course.
Exactly. So, just conceptually, how do you guys deal with I don't want to say losers, but
The ones that didn't work?
correct.
Well, a couple ways. First of all, of our names, somewhere in 80+% are in our top 10. So the rest of the portfolio is small for a variety of
Sure,
reasons.
sure.
Some is small because intentionally small. Some were big ones that are small ones. And so that's where we are. Our view is, unless the company's out of business, we don't write it off. We write it down to zero, but we don't write it off. And we learned that lesson several years ago. We had a company that we had written down to zero, and you could have easily just crystallized the loss. But through negotiations with the company and other shareholders, we got a recovery that was actually a gain from our initial investment.
Okay.
So they're there, and you can see the names.
So you're not inclined to, as they say, throw in the towel.
Only because there's just optionality. If it's already zero, it's reflected in our NAV.
Right.
So for our investors, we're not attributing any value to it. So it's not impactful to their investment decision. But things happen, and all of a sudden something changes, and that company becomes valuable. So, but we're not, obviously, like anyone else who invests. We've had some that haven't done so well,
right.
But we've had enough good ones to take care of that.
But from a management perspective, right? Because it's 36 positions plus all the ones that you're looking at, plus the board level activity that you guys participate in. You're right.
The ones that are zeros, they are. We check in with them, but make sure they're trying to do what they're trying to do. That doesn't take a heck of a lot of our time.
Okay.
Our bigger portfolio names, they take as much time as they take to stay in contact with management, ongoing calls, monitoring the situation broadly, their valuation so that does take a fair amount of time. And then we spend a fair amount of time finding new. I mean, I'm really, really fortunate. I have a really, really good team, and they work very, very hard, as do I.
Excellent. Now, talked about quite a bit about some various names in there, but the one I don't think we gave enough due is probably OpenAI.
Sure.
How did you guys come to find that? What do you think the long-term opportunity is? Big picture, if you want, with OpenAI and AI in general.
Well, first of all, OpenAI is an extremely difficult company to access because of their capital structure.
Okay.
And we spent quite some time trying to source it in a way that we knew what we were actually buying was interest in OpenAI's profit interest.
Okay.
And we wanted to own it because it is the clear leader in what's going on in AI. And they literally have an announcement every day of something like, oh my goodness, how did that happen? Or, oh my God, it's amazing to watch. And we were able to buy it. Based on our diversification rules as a BDC, we bought the most that we could buy, which was $17.5 million. And we invested at $150 million pre-money, or $157 million post. They completed a round at the end of the first quarter at a $300 billion valuation. I said million, I meant billion before. And I suspect OpenAI is going to be $1 trillion company.
Well, I can only say that when I talk with folks about, who are they using for AI, there's Claude and the Perplexity.
Sure.
Nobody mentions them. It's all ChatGPT.
Right. It's an amazing to watch from the outside and all the different things they're doing. It's incredible. And that's why they've been able to attract both the capital that they've attracted and the valuation that they were able to achieve.
Is there any kind of fun thing that you have used ChatGPT for, Mark?
No, not really. But I will tell you, given yes, not really anything terribly special.
Okay, all right. Sounds like there's a little something
No,
there.
when you get to the power of consumption that occurs for just querying something silly.
I know what you mean.
That part's sort of amazing. It's like, well, if you just ask it what time it is, and all of a sudden a light goes out in somebody's house in Oklahoma City because of the power drain. It's not really what happens.
No, but pain points, as I like to say, are investment opportunities, right? That's why you own some of the nuclear stuff. You have that nuclear exposure in your portfolio. We have Eaton in our pro portfolio. Sure. So, okay. Well, Mark covered quite a bit.
Right.
Anything we didn't talk about? Any lasting thoughts you want to leave the viewers?
Oh, first of all, I truly appreciate the time spent with you now and in times before. I've been in the business an awful long time. This is clearly one of the most exciting periods to be on the investment side. It's exciting just to be watching all of this. And the rate of change is amazing. We are very fortunate that we are right in the middle of it, and our ability to identify, have access, and deploy capital against it is probably the most fun experience I've had in investing in almost 40 years.
Excellent. And Mark, last question. Folks who want to learn more about Surro Capital, what's the best place to go?
Certainly our website, our social channels. Feel free to email me directly through our IR site. I am really responsive to all our investors. I want folks to understand our story. We're proud of it. I'm excited about it. The market is taking notice to it, which is always fun, but I'm happy to, I love talking about what we're doing, so I'm happy to talk to whoever wants to reach out to us.
Excellent. The only other thing I would add, go to the SEC website, pull down all the financial filings, 10Ks, 10Qs. There's a ton of information in there.
That's true.
All right. Thanks, Mark.
Thanks, Chris. I appreciate it.
All right, folks. That is this week's Stocks and Markets podcast. Thanks for tuning in. We'll be back with a fresh episode before you know it.